Hello and welcome to Venture Voices. Welcome, Stan. Great to have you with us today. Would you mind introducing yourself and Fuel Ventures to begin with?
Yeah, firstly, thank you very much for having me. So yeah, I'm Stan Williams. I'm one of the partners and directors at Fuel Ventures, which is a VC fund I've worked for about the last 6.5 years now. Um, we invest in seed stage technology companies, yeah, looking for scalable tech deals that we can back and support and help them on their journey towards exit.
Time flies, 6.5 years. I remember Xander were in the same offices of Fuel when they first kind of kicked off in rocket space,
Yeah.
Angel. Why 6.5 years ago did you decide to join Fuel?
Uh, Probably twofold. Firstly, Mark Pearson, so our founder and managing partner, the firm was only a few people when I joined, so it largely was about him and his vision. Um, I met Mark and he was a very humble but also very successful entrepreneur who, you know, you meet a lot of people who got lucky once in life, but he got very lucky on his own business and successfully exited a couple more. So I really could see quite quickly that he was someone who was very smart and had a very good track record of actually kind of delivering on that. And then the second part was I really liked what he'd been building. So I spent previously about 5 or 6 years at an angel network in London doing earlier stage deals. So, kind of pre-seed deals, SEIS deals, where we were raising 100, 300,000. But we always kind of struggled with the next part, which is, raising that 1 million, that £2 million round. It's very hard to find enough angels to raise that kind of money quickly. And we never really like gave them that much support. We'd introduce them to the angels and then we'd kind of take a back seat and let the angels get on with it. And Mark was building a fund, or is, still is building a fund, I should say, um, to give companies a really decent amount of money to continue backing them as they grow, kind of take away that fundraising pain, I guess, for them, and also be as supportive as we can be during that process. So a lot of that resonated with some of the pain points I already knew existed in the market and was kind of inspired to join that journey.
Well, it's good to know Mark's not retiring based on that conversation. You're still building the fund, which is great. And
Yeah,
you've
he
done,
has this great phrase, which is we're only getting started. And he reminds me on a regular basis, and he's exactly right.
that's great. The balance of investor and operator and ex-entrepreneur is obviously one that has been very successful in the past, but also is hugely important. How would you define your different funds and investment portfolios?
So we started investing in 2015 really out of an EIS fund which invests at seed. And that's always been our key strategy. It's to write decent sized tickets at the seed stage. What we've done subsequently is moved up the chain and moved down the chain in terms of stage. So we've now launched a pre-seed fund, which can invest up to £250,000 for companies who maybe don't have so much revenue or traction, but need to get started. And then we've also launched two vehicles, which basically follow on into our existing portfolio companies. One is structured as an EIS fund, one is structured as a VCT. Both have the same aim of basically supporting our winners and backing our top performers as they grow.
And on the pre-seed, are there businesses in there that are pre-revenue or is there some revenue?
Yeah, we found ourselves doing one of two things. A, investing in a company at EIS stage who had SEIS, but we didn't use the SEIS allowance, which felt like a real waste to us.
Yeah.
And the second one was turning away really great companies where we could see there was a great founding team. We were really excited what they were building, but they just hadn't built the product out yet. And they said, look, I only need a couple of £100,000 to build out the product. So the pre-seed fund is exciting because it allows us to back those founders, give them the opportunity to go and build the product. And then if they can get customers and revenue and traction, we're there with our next fund to support them. So yeah, it's basically giving a real chance to those really early founders who just need some help getting off the ground. And not everyone's got friends and family and a rich aunt they can turn to raise that first
Mhm.
initial round.
And rough numbers, how many in the portfolio in the different kind of, I don't know, pre-seed, seed, seed plus?
I would say we probably have about 160 companies across the entire portfolio these days. And that's probably split kind of 90 EIS companies, 70 SCIS companies. So
Mhm.
yeah, like a little bit of overlap between the two funds now, but yeah, broadly those kind of numbers.
And it's fair to say I would describe Fuel Ventures as a firm with personality, which I think is fantastic in terms of, obviously shaking things up a little bit. But how would you, I guess, define your thesis? Because I do think you're pretty direct and honest about what you're trying to do, and I think that's quite yeah, I think that's quite a nice way to approach the market. But yeah, give it from your side.
Yeah, I think one of our things that we're known for is our reputation as being quite bullish and being quite ambitious. So we invest in tech companies, as I said, and our aim, unashamedly, is to invest in companies which we genuinely think can deliver a minimum of a 10x return on investment. That's kind of our bar internally when we're looking at a company. If we don't genuinely or hand on heart think this could be a 10x plus returner, we'll pass it by and won't invest in the company. There's a lot of good companies out there, and that's a really good um, gauge of whether we should be investing. So I think that makes us stand out and be a bit different. I think, that's not for everyone's taste. Some people look at that and go, that's unrealistic. You're not going to get 10x on some of these winners. But I think our kind of internal philosophy is that even if we don't make the big returns that we're talking about, but we land kind of halfway in between, even if we were half right, we're still going to do well overall. So I think that's a key just philosophy, as I said, of the fund, which is quite key. Um, Other key differentiating points is we usually invest with what I call full conviction. So I'll often be speaking to a founder who says, "Look, I'm raising a £2 million round. I may piece together this much from this fund, this much from another fund," and Fuel will come along and say, "Look, we can take the entire round. We'll write the whole term sheet, and we'll move relatively quickly. So from term sheet to closing the deal, we'll aim to do this in 3 to 4 weeks, which is pretty quick in terms of the VC space." And then finally, back to the conviction point, just to carry on investing. So if we invest in a company that we like and we genuinely think it's a great company, if it goes and achieves its aims and its proof points stage by stage, we'll continue backing that company. There's some companies we've backed, I think 4 times now. For example, there's a company called Hotel Manager, which we've invested in from every single one of our funds. So, that would be a great example where we think it's a fantastic company, and as it grows, we're more than happy to continue backing it. So I'd say they're the kind of key differentiating points against other VCs we work with.
Yeah, and I think that the unashamed honesty around that is, kind of refreshing. Obviously, there's many ways to invest, and obviously the PE model and different VC models, maybe a slightly more kind of sustainable growth model. But you've stuck with what you set out with 6 years ago, 7 years ago. Whereas there's obviously other individuals or other investors that have changed or maybe communicated they have changed, but haven't really. So I think that you've been brutally honest with that, which I think is quite refreshing. The ease at a 2 million raise being done with one investor, as opposed to having three or four and a bit of angel money on the cap table, the ease of time for the founder is significant. Obviously, I angel invest a little bit and work with a lot of seed and Series A businesses, and the time for the CFO and the founder when you've got three VCs, a family office, and an angel fund involved on a 3 million raise is probably more of a distraction than it needs to be. So I think that's obviously a really big selling point. And as you say, hit the metrics and build a long-term partnership with them, which is what it sounds like you're trying to do. Just on metrics then, so pre-investment, what sort of, I guess if we're talking about a 2 million seed raise, what are the metrics or the soft and hard metrics that you look for that would make you feel comfortable going all in on a 2 million seed raise?
So I think there's a number of key things that we would look for, the obvious one being just an excellent founding team. The thing that we need to get really excited about is the team. We all know it's a very long journey with these companies. It could be anywhere between 5 and 10 years. There's going to be challenges. The business is going to pivot. The market's going to change. New technologies are going to come out, and through that all, the one constant is the founding team. So that obviously has to be right. We really need to believe that there's a scalable business model there, something that can be scaled quickly, and be capital efficient. So we're not looking for companies that, it costs a couple of £1 million every time you open a new site. We'll predominantly invest into software platforms, which, apart from getting some more servers and maybe hiring a couple more staff, it's not too costly to grow and scale those companies. And doing it in a capital efficient way. There's nothing more attractive than a company coming to us and saying, look, we've bootstrapped to this point, we've done all this on a relatively small amount of money. Look what we could do with a much larger raise. We also look quite carefully around the velocity of growth to this point. I mean, it's very difficult at the pre-seed stage, but maybe if a company's kind of later seed coming up towards Series A, you can start plotting that growth graph, seeing some consistent growth. And I think the speed of that growth is what's very attractive to us. And also having a look at the pipeline. It's all very well what they've done before presenting to us, but what does the pipeline look after we've made that investment? And then the last one is really just around ambition. So, you can see a lot of good metrics and a lot of good things that you would like about a company and make you want to invest. But if everything goes right, how right can it go? And this comes back to the point of, okay, this company could go really, really well. The most it could ever give us an uplift is 3x or 4x.
Mm-hmm.
Okay, maybe it's not the right kind of company. So yeah, companies operating in £1 billion addressable markets, where we think if they took, 10% or 20% of market share, this could easily be £100 million revenue business. And, we would be walking away with a very, very high return. So yeah, all the kind of stars need to align across those points for us to have conviction to invest.
And you've invested, and then you're working out whether to reinvest. You've obviously got some similarities of the key metrics to look at. I'm sure the founding team becomes another key consideration, and the performance. But how do the metrics change? What becomes more important and less important when you've worked with them for a year and you're thinking about whether to follow on?
Yeah, it's incredible what you learn over that year.
Yeah.
There's usually the presentation that gets given to you, and then there's the first board meeting you walk into. And you know, I find the follow-on investments fascinating because you do suddenly know so much about the company. You understand what the pain points are. And it never goes to plan. It never goes perfectly. It always costs more money. The growth is never what it originally was planned to be. But I think the key things that we need to look at is still, are they on that journey? And is the company growing? Do the customers like it? And how are we getting on with the founders? How's that relationship? Have they proven themselves to be the right team? And I think, yeah, it's about getting comfort across them hitting their proof points and knowing that you've backed the right team. It gives you conviction to want to invest again.
Would you say it's a bit of a balanced scorecard approach? So, say you had a founding team that actually are a bit of a pain to work with and aren't that great in some ways, maybe a slightly challenging communication, but they're hitting the year-on-year growth numbers. Then that's scenario one, and maybe another business where you really believe in the actions they're taking, but they're not quite nailing the year-on-year growth figures for a variety of reasons. Is it a balanced scorecard view, or is there?
I'm trying to think of real life examples now, and most of the companies who are smashing their numbers and smashing their metrics are very pleased and happy to send us them. Even if it's
True.
via WhatsApp, just letting us know that it's yet another record month. It's often when the companies go a bit quiet and don't send you their numbers one month, it's because things are not going well, and actually they're the times when we really need to get involved and support the companies because they're the difficult months, and that's when they actually really need us. So yeah, usually the ones who are good at reporting are also the good performers. But you're right, a company could be doing really well, they might not be so good at reporting. we might not have the best relationship, but that doesn't necessarily mean it's not a company that we should back again.
And on month growth or year on year growth, what percentages, and I appreciate this is a broad question, but a rough kind of percentage month on month or year on year that you look at when you get a text message or the WhatsApp with the new board pack or however you get it, do you go, that's brilliant? I'm super pumped for them. And at which stage do you go, okay, we may have a problem here?
Yeah, again, it's very hard at the very early seed stages, but as the company starts to develop, our kind of growth trajectory that we normally look at is, like 3x growth in year one, 2x in year two, 2x in year three, and then dropping to probably 1x in year four and year five. So
Mhm.
they're the kind of like numbers that would wow us. If a company grew 3x in a year, we would be delighted. Some of our companies get to kind of Series A and that growth drops, and it's somewhere between, you know, 50% and 100%, still okay. But they're the points where we think, you've probably dropped a little bit below what we'd expect for VC growth metrics. As a company that's well funded and has money to spend, it probably implies some of that money isn't being effective. But that's the kind of the trajectory that we're looking to build. So yeah, the dream company would follow those growth numbers, and you know the top winners in our portfolio actually smash those numbers out the water, which is great to see.
And it's interesting, isn't it? Because if you do hit three times, two times, one time, then you maybe at Series A and it starts to be 20 to 30%, that's still a very sellable business, isn't it?
Yeah, yeah,
Versus where you've invested 3, 4 years ago.
yeah, yeah.
But not a fuel ventures business, but still a brilliant success. So a founder and a founding team that should be pumped to kind of hit those numbers based on how many startups don't get to a million revenue, let alone the numbers that you're talking about. In terms of specific resources or support that you offer post investment, what sort of areas do you really help with or dig into for the founders?
So I think when we kind of were building Fuel Ventures and building the team and building the resources, we looked at the things that founders struggle with the most and some of the reasons why a lot of companies don't make it. Um, Funny enough, our top one was fundraising. We thought that fundraising on the pie chart of not many founders are very good at it, and it's a key reason why a lot of companies don't make it. There's been good companies in our portfolio where they thought they had a term sheet, that term sheet got pulled and the company failed. And to this day, I still think that was a good founder and a good business, but fundraising just basically, you know, was that roadblock for them. So that's been a key one. So we've built out a lot of internal resource around fundraising, um, people who go out and have lots of coffees with VCs, talk about our portfolio companies, talk about our recent investments. You should track this, you should track this one. This is very exciting. We're about to close on this company, because what we've experienced from Series A and Series B investors, they like to know the company over a long period of time. Sending a company one week telling them they're about to close the next week, and they won't be interested. They won't have a good enough understanding of the company to give them a 10 to 20 million pound check. So yeah, going out and doing that fundraising piece and supporting our portfolio companies has been key. I've seen Fuel do that on a scale, much larger than most VCs. It's usually a couple of introductions to some friends, but Fuel has really kind of turned that into a proper process and a proper system with a team behind it. The second one, which is more traditional, is just the hiring process. So many VCs have kind of in-house talent teams now, so do we. Just supporting the founders, making key hires. Again, we're giving these companies a lot of money. What they're spending on hiring the right people. You want to make sure they've got a great pool of talent to choose from. And obviously there was just obvious benefits from a portfolio approach. So if you've got one portfolio company who's hiring someone in sales, you get together 30 sales candidates, they choose one or two. Well, you've still got, 28, 29 great sales candidates that now you could reuse across another portfolio company. So there just seems to be some really obvious crossover that we could use. So yeah, I think fundraising and in-house talent support has been a key one, but in general, we meet with these companies once a month with the founders, and there's all kinds of help and requests that we can give. And it's not just limited to the fuel team. Fuel team's 23 people, but our investor network is, 1,000, 2,000 people. So like there's 1,000 investors in the fund itself, and then there's their extended network as well. So it's very often that we'll go to that network, pick on experts, bring in certain people. These investors also sit on the boards of companies with us. So yeah, it's not just about limiting it to the fuel team, but thinking more broadly about that wider network, because there's a lot of business expertise in there, lots of experienced people and people that we can turn to.
I think also at this stage of the business, the cadence of a regular monthly review
Mm,
actually helps founders and businesses to professionalize and to measure what matters and to make sure they're doubling down on actions that are moving the business towards its goals and spending more time in that zone of focus than getting distracted. So, I don't know if you feel that with your portfolio in some ways, it just kind of narrows the headlights onto the track that they need to be driving on.
yeah, exactly. Yeah, I can agree more.
And it's kind of an unhit, obviously that could be more general across VCs in total, but the consistency of that monthly meeting and all of those other bits you've mentioned are super important. In terms of pitching, then, are there any common themes of the best pitches you've seen from founders? What are some of the things you see or the way that it's communicated that you've always thought were kind of top 10%?
Um, I think just in terms of just characteristics of the pitch itself rather than necessarily the content is firstly just enthusiasm and excitement. I've heard other VCs say this of just, this company's not right for us because we just didn't get excited enough. And partly you just need to leave the meeting just with a real buzz and energy and thinking, you just want to run back to the desk and tell everyone you're just in a great company. And that genuinely does happen. So I think, yeah, there's a real enthusiasm and excitement. I've never walked away from a pitch where, it's just very dry and the founder seems uninterested thinking I want to invest. So I actually
Yeah,
think weirdly that's a key thing. You've got to see someone with passion who really loves what they do. Um, Another one would be just telling a story, explaining to us why this is going to work, why other things haven't worked, why the timing's right. There's just a real storytelling element about the pitch itself, which really resonates. It's not too formulaic, it's not too polished. It's just they're just telling you why this is a good business and why they genuinely want to do what they're about to do and why they think it's a good investment opportunity for us. Um, and then just like a little bit of yeah, that desire to get into the route. So like you usually from the very best pitches, they kind of tell you something which is going to be hard for you to get into. It's not, oh, I could wait around 6 months and wait for your money stand. The very, very best pitches are usually the ones that you have to kind of move quickly and do all your best sales techniques to make sure you just squeeze into that round at the end. So they're kind of, they
yeah,
create, that fear of missing out, right?
yeah, that's brilliant. Yeah, really good kind of snapshot there. Again, a lot personality driven, energy driven, as well as obviously a brilliant pitch in terms of the product, but the feel of face-to-face meetings, you just get that buzz or you don't. And it's tough for founders because obviously they're doing a lot of these meetings, right? So it's keeping the energy up and enthusiasm up and purpose up when you know that you're doing the same pitch again and again and again. But if anything, maybe that's a test of why the founder is interested in this segment that they're in anyway. If they can be passionate with purpose on the product you've developed 50 times, then they genuinely must be passionate and excited about it without letting that energy dip.
Yeah.
What are some of the main challenges you see consistently of the founders that are backed by Fuel?
Uh, Kind of the operational points I just spoke about, but hiring is always a challenge. Like I always say to people, you have to remember that when we invest in a company, we're kind of investing with a runway of 15 to 20 months. So you basically have 15 to 20 months to show a really clear growth and evolution of the business in order to raise that next round. That's the key thing. So if you go out and hire and you hire a team and you know there's going to be a ramp up period, and you know there's going to be an embedded period, and that takes a period of time. If you get that wrong twice, you know, you bring on board someone for 6 months, it doesn't work. 8 months doesn't work. You know, that's it. You bring on the wrong sales team or the wrong sales manager, and the growth is not going to be there. So I think, yeah, hiring is an absolutely key one. And again, fundraising. Founders are not born to be fundraising experts. It's not necessarily their skill set. You can have a great kind of technical founder who's great coder, really knows how to build a product, really understands the customer pain point. It doesn't mean they know how to go out and sell their business and do a pitch. So I think that's key. And then the one that we often see is just, it is that use of that money and spending it effectively. Again, it's, you know, you can raise the money, but also can you use it in the best possible way? And again, you don't have much room for error in that. If you misspend the money, if you raise 2 million and the first million goes and you've not achieved anything from that or seen any growth from that, well, now you're down to 1 million, a much shorter runway, and the stakes have just risen because now you've got to really make sure that second million that you're spending really does deliver and you do spend it on the right channels and you do attract the right customers. So that's another pitfall that we kind of see time and time again.
Yeah. What are some of the soft skills and hard skills you see in the founders of your best performing portfolio companies?
The first thing I always say about like the top founders is that they're experts in their space, in their individual industry or sector. Our top band of portfolio companies, they really understand the market. They really come to us so clear on the pain point. They've probably worked in or around the sector before. They understand what that pain point is, and they can come to us and explain it so clearly and how this can be monetized. So that's absolutely consistent. Often they'll have really good access as well. It's just part and parcel of again of being an industry expert is that they can knock on doors and open doors that other people aren't able to. Yeah, for example, we have a company in the hotel space where the founder just has really good access to hotels and can go and be in a room with these people and pitch them in a way that his competitors can't, which is great. And then finally, like they're just they know how to execute on this, and it's usually because they've either done it before or they've seen the playbook before. An example I love of this is one of our founders. He didn't actually even work in the competitor business. He worked for an investor who sat on the board of this business, got to observe the business through board meetings, got to see how it grew, got to see the playbook they applied, and then went and set up his own thing in a different market. And again, you don't even need to be a second time founder, but you need to understand where the dots are and where you're going to go. And those founders who can again come to us with a clear story of we're going to do this, and then we do this, and then we do this, and this is how we grow a really, really big business. And that those kind of couple of things are pretty unanimous amongst our top performing founders.
And is there anything from a personality standpoint in terms of being able to build, inspire teams below that some of them have, or is that so different founder to founder?
I honestly would say it's so different. I would like the personalities of our founders. There's not many consistencies. I know apart from being hardworking and being ambitious, obviously the
Mm.
obvious ones. I would say a lot of the other characteristic traits. Some are more technical. Some are more charismatic. Some are, as you say, are great motivators. Some are great public speakers. Some are not. So, some would happily defer that to anyone other than themselves. So, yeah, I wouldn't say there's as many personality characteristics across the founders that we look at.
And this is obviously high level numbers and assumptions here, but what percentage of your portfolio do you think would potentially benefit from a new CEO coming above a founder, or the founder moving to chair, or the founder, exiting the business completely. Obviously, we've heard many times of the different stages of, 0 to 10 people, 10 to 50 people, 50 to
Yeah.
150 plus. There's obviously lots of kind of CEO replacing founder chat, but yeah, what percentage of your portfolio do you genuinely think a new CEO coming in could actually benefit the business?
I want to say we've probably seen it like in 10 to 20% of cases to date across every portfolio company. Obviously not the pre-seed ones. I'm talking more, as you say, it's all about the stage, right? You know, they are always the right founders to take it from 0 to 1, but from 1 to 2 is the key thing. And are they the right founder from that? And I'd probably say in 10 to 20% of the cases, it is another CEO or chairman that comes in to run the business. And especially this year, we've seen that more driven by the business than we have by ourselves. It's not been a board thing. It's not been, it's been very much a personal decision and a decision amongst the team to just say, I just don't think I'm adding real value to this business anymore. I think there's someone else who could do this, and you know, either my skills could be better used in a different part of the business. Maybe I could go and join the tech team. Maybe I could launch a new product for the business. Um, or sometimes it's just a step away completely. So yeah, you're absolutely right. It does happen, you know, frequently across the portfolio.
Do you think there's more founder burnout, tiredness in 2024 than 2 years ago, 3 years ago?
I'd probably say we've been, it's a good question, really good question. It's quite a thought-provoking. I would say we've seen it a lot this year. Maybe it's just recency bias in my head, but I think we've seen it a lot more this year. But yeah, maybe you're right. Maybe there's a bit of a product of it's been a difficult market. Times have been hard for everyone, and that has kind of led to more founder burnout across the board.
Yeah.
Yeah,
It's
yeah,
it,
I probably support
it's
that.
pretty brutal
Tough.
on
It's very
occasions,
tough.
isn't it?
The market's tough. The fundraising market's tough at the moment. Yeah, you've got to be. I'm always in awe of our founders. They are the superstars. It's amazing what they do. Their resilience, their drive. They have so many people telling them it can't be done, and it's not working, and yet they persevere. So yeah, having seen it for 10 years of my career now, it never you know fails to resonate how tough it is for founders to do what they do.
And if you were to put yourself into a founder's shoes and you were a founder of a, I don't know, 3 million ARR business or 2 million ARR business looking to raise a 10, 15 million Series A, what are some of the main priorities that you would do ahead of that raise? Say the raise was going to happen in, I don't know, February or March next year. What are some of the things that you'd really want to get your ducks in a row sorted on?
I think number one would be making sure I've got the right team around me and the right C-suite. You know, VCs are very quick to sniff out when there's gaps in the management team, or the management team just isn't ready to accept that level of funding. So I'd be on a C-suite hiring spree, making sure that all the kind of gaps have been filled. Um, I'd be making sure we went out and raised when we had sufficient cash in the bank. There's nothing, worse than raising when you're running out of cash. And again, investors see that quite clearly. And unfortunately, some will take advantage of that situation. Um, I'd make sure we were ramping up growth, if that meant spending a little bit more on marketing, whatever it was, incentivizing the sales team, whatever it takes, kind of thing. I think it's important to show good growth and attract a good valuation going into that fundraise. Um, and then on more just like a simple practical level, just getting, as you say, the ducks in the row, the data room ready, the model ready, the deck ready, having all those folders filled, just that if an investor does become interested, you've got that data and you don't leave them
Mm,
waiting around for weeks to
yeah.
come up with it. And then again, it just goes back to like being able to tell a story, being able to explain that, if we put this much money, we put 10 million in the top of the funnel, this is what's going to come out the bottom of the funnel. And this is how we can scale this business basically. And,
Yeah, cool.
being ready to answer some of those challenging questions that you're inevitably going to get asked.
Sounds like you're ready. Sounds like you're ready.
That's so easy when you just like just name a couple of things that you can do, but obviously there's so much more that
Yeah,
goes
yeah,
into
but I
it.
think
That's actually the really hard thing is what I'm describing is basically a full-time role of getting a business ready for fundraising, working on the numbers, preparing, answering due diligence questions. Somehow you have to do all of that while also running the business. Answering your customers don't go away, your business doesn't go away. So it's like get the business to perform the best it's ever done while also being really, really distracted. And you know, that's why it's incredibly tough.
and it's fair to say if you're raising a 10, 15 million Series A, you're not going to have full-time C-suite hires in most of those roles. So actually, I mean, I don't know what your thoughts are on fractional v full-time, but maybe touch on that now.
Yeah, we often advocate it because exactly as you say, you're not going to be able to afford to have those people in place. There's not always an expectation that you will, but at the same time, you know, VCs expect good numbers. They expect the model to be great. They expect the business plan to be thought out. They want to know there's a marketing plan in place and there's a hiring plan in place. So yeah, if you can bring people in on a fractional basis to prepare those documents and prepare that material, yeah, it's absolutely key, I think, going into fundraise. And you have to do it even if you can't afford the full-time hire, then yeah, fractional makes a lot of sense.
And you've raised the 15 million, you did particularly well at the valuation you were targeting. What's the first couple of things you do post-investment?
Uh you normally you'd have like a 30, 60, 90 day plan. Um you would obviously focus on what the key priorities are for that business, and that differs across pretty much every business, but invariably it involves just absolutely sitting down with the investor and making sure everyone is aligned on the budget and the plan. You may have presented it to them in the um pitch, they may have had some questions and some thoughts. Now let's get everyone in a room. Investments happen, let's be really clear that we all agree and are aligned in the direction that we're going into. And then you're starting your hires, you're starting to enact the plan, and you're getting things off and going. But you certainly need to make sure that everyone's reading off the same hymn sheet, because you don't want to come back 4 months time and say, well, we just gonna made 5 hires, and they said, oh, we asked you about that in due diligence and we didn't agree with those 5 hires. Well, we never had that conversation, and that's where problems can occur.
It's where the deep metrics around capital allocation strategy come in, right?
Yeah.
And presenting an argument of where cash should be allocated to different growth levers, and you have a challenging conversation on where we're going to get most return on the key metrics, if it's top line or margin or whatever it is. So again, if the founder's not from a analytical or finance background, the fractional CFO becomes particularly important, as well as the leads on go to market or customer acquisition, or marketing, etc. So it's really, really interesting. Where do you think, going into 2025, which is quite a scary thought, where do you think the venture capital market is moving in the next year or 2 years? Obviously, it's been a tough 2 years off the back of a bit of a boom.
I like to think it's going into more positive times. We're quite excited to feel that we're seeing quite positive signs across the market. I think more rounds will get done. I think towards the second half of 2025, we'll start to see more exits, more IPOs. So I think there's kind of better times to come for venture capital compared to the last year or two. And then just like bigger trends, I think I think we'll obviously see the use of AI across everything, and venture capital will not be immune to that in any way, shape, or form. Um, you know, Venture capital is an industry where there are a lot of data points. Every time I look at you know, the total addressable market of a company, I think about, there's so many data points that have gone into this. Which bit of data did they draw upon? Which bit of data did they not? You look at a competition slide. Did it include all the bits of competition? Which companies are missing from this? Have they portrayed all the companies in the correct way? And I just think AI will be able to do a lot of that heavy lifting very, very effectively. And I think that's going to be like one of the biggest changes. But I think the first round will just kind of be making our lives easier and aiding us and helping with due diligence. Um, yeah, freeing up more time basically
Yeah.
from doing a lot of the heavy lifting.
Yeah, cool. Which means maybe a bit more operationally supporting some of the portfolio, connecting them, using your network, being a bit of a sounding board, or a shoulder to lean on those
Yeah.
tough days. Well, look, thank you very much. Last couple of questions, which I wanted to kind of finish off with. If you weren't in the venture space, what do you think you'd be doing?
Well, I've never had a job not in the venture space.
So you might be
Partly,
unemployable, to be fair.
partly I have no idea. I think I would just be working for one of our portfolio companies. I think
Okay.
I'd be working for a startup trying to, help them yeah, achieve what they want to achieve.
Would you be?
I don't think I'd be the founder. I think I would, again, a bit like Fuel, I'd be a kind of an early hire who doesn't need everything on his shoulders, but is super happy to get involved and be part of the journey.
Yeah, okay. Product ops, marketing, go to market, what?
Probably ops. Probably
Yeah.
ops. Yeah.
Okay, cool. And then last one, if you had to recommend one book to a founder that you love and why, what would the book be?
I used to always recommend that founders read Venture Deals by Brad Feld. Just because again, you know, you come into the founder journey and no one prepares you for what a term sheet is, and no one
Yeah, so
prepares you what
true.
a vesting schedule is. And, you hear these horror stories of founders taking two term sheets and one of them's got a bigger number on the valuation than the other. So they go with it. And then they find out it has this four times participating liquidation preference and they can't understand what that means. But basically, it means that you would have been better off going with the other term sheet. So always used to say venture deals by Brad Feld. I suspect you could ask a lot of those things to ChatGPT these days. I'm sure you could ask
True.
what is the liquidation preference and just get a straight answer. So, what else? Maybe I think it's either called Predicting Revenue or Predictable Revenue by Adam Ross.
I like
That's
that.
a pretty good book for you know just working out. It kind of feels like Moneyball-esque in certain parts of that book, where it's
Yeah.
just about if enough numbers go into the top of the funnel, it shouldn't be a great mystery that revenue comes out the bottom. There is a way to do enough leads and generate enough of a pipeline to know on a semi-predictable basis how much a company's going to do in revenue. And I think in building, some of our portfolio companies have basically built their whole revenue models around that book. And they've been some of our better portfolio companies. So yeah, I think that's
Yeah, cool.
a good
I
secondary
will
recommendation.
I'll check that out and we'll add it to the link. And again, thank you so much for
It's an absolute
sharing
pleasure.
your time and your insights today. And I'll catch up again soon.
Brilliant. Thank you, Andrew.